Hello, everyone. It's been a little while. Q1 has been very busy. Most companies report their earnings in the first quarter of the year, their annual earnings. And I've been updating Rated A, creating all the new ratings and all that. But I'm super happy to be back. Today is going to be a very interesting video, a very useful one too. We're going to be talking about See's Candy. Now, if you're a fan of Warren Buffett or if you're a value investor, then you definitely have heard this name. This company is famously in Berkshire Hathaway's portfolio. But the way we're going to talk about it today is not going through an analysis of this company. Obviously, it's private under Berkshire Hathaway, so there's no specific numbers to look into. However, what's interesting about this one is that Warren Buffett and Charlie Munger have mentioned See's Candy as a case study in many of their conferences and many of their annual reports. And so, as I was browsing the internet, I came across this blog, 25IQ, who wrote an interesting piece in 2016. So, it's been a little while now, but the quotes in this paper are never going to go out of date. And so, I would like to thank 25IQ for giving me this content, obviously. But what we're going to do today is we're going to go over a compilation of quotes that are directly coming out of the mouth of Charlie Munger and Warren Buffett and seeing what types of lessons we can take out of those. But first, before we begin, I briefly want to mention the portfolio performance. We're so far beating the S&P 500 and the MSCI index, 8% for us versus 3% for the MSCI and 1.6 for the S&P as of the start of March. So in the 3 weeks since the start of March, the S&P is down even more. It's now in negative territory for the year. Our portfolio is around 6 or 7%, so it also came down a little bit, but we're still handily beating the index, so that's always good news. In terms of the portfolio, it hasn't changed much. The three biggest holdings are still Visa, British American Tobacco, and S&P Global. And as of the companies that I've been buying, well, we've got LVMH that I've been buying into and Evolution. So both European companies. We'll see how that goes. So as we go through the quotes by Warren Buffett and Charlie Munger about this company, what you'll notice is that it sounds very familiar to another company that's in my portfolio. Spoiler alert, it's LVMH. And so you'll see, we'll go through them together, obviously. But when you listen to the way Charlie Munger and Warren Buffett talk about this company, a lot of it can be linked directly to the way LVMH operates. And so that's always, good for us as investors in LVMH to see that the lessons that, they've taken from this high quality business are also applicable to LVMH. All right, without further ado, let's get right into it. The first quote is by Charlie Munger, and it says, "If we'd stayed with the classic Graham approach, we wouldn't have the record we do. See's was the first high quality business we ever bought. After nearly making a terrible mistake of never buying See's, we made that mistake many more times. We're apparently slow learners. If See's had asked $100,000 more, Warren and I would have walked. That's how dumb we were. Someone told me, you guys are crazy. There are some things you should pay up for, like quality businesses and people. You are underestimating quality. We listened to the criticism and changed our mind. We started with a sure to fail department store, a trading stamp business sure to fold, and a textile mill. Out of that comes Berkshire. Think about how we would have done if we had a better start. See's Candies was acquired at a premium over book value, and it worked. Cone, the department store chain in Baltimore, was bought at a discount from book and liquidating value, and it didn't work. Those two things together helped shift our thinking to the idea of paying higher prices for better businesses. So, the first lesson here is to stay humble and never stop learning. Even for geniuses of this art of investing like Warren Buffett and Charlie Munger, they had to go through years and years and years of iterations, of mistakes, until realizing wait, buying quality businesses is actually more profitable for us than buying deep value businesses. But it's always good to remember as well that times change, right? In the 1940s, 50s, 60s, Ben Graham's approach really worked. And he would look at the book value of a business because back in those days, most of the company's value was in its physical, tangible assets. And so that way of investing worked. But little by little, as technology improved, that investing style kind of became obsolete. And if you had stuck to that way of investing, even though it worked for a while, it wouldn't have worked very well for you, would have. Another example like this is the efficient market hypothesis, right? This was a school of thought in the 80s and 90s where people thought that everything in the market was priced in. Every good news, bad news, everything that the market could know was reflected in the prices of stocks. And this school of thought led to many debacles in the stock market. The first one being the Nifty 50, when the 50 greatest companies in the United States, there was this expression that you couldn't pay enough for them because they were such high quality. And yeah, these companies were high quality for the most part, like American Express, Johnson and Johnson's, Philip Morris. These are still household names today. But they also had names like Xerox and JC Penney and Kodak, Polaroid, all these businesses that 20 years later which were pretty much extinct. And then there's my own personal experience, right? Even me, my humble beginnings as a value investor, I used to focus a lot more on financials and looking for deep value, right? For me, the most important was finding a company that was selling for a low multiple to the free cash flow. And that's how I ended up buying companies like Intel or like Viatris. My problem here was not realizing that the quality of the business was the most important factor, and that's what I needed to focus on. Instead, I was focusing on the price. But what's important here is that eventually, after making mistakes for a year or two, I kind of, kept on learning, kept on educating myself until realizing that quality is the most important thing to look for in a business. And all that feeds right into the second lesson from the quotes we just read, which is to pay up for quality. I have here in my notes, a business with superior quality bought at the right price can still be a bargain consistent with the principles of value investing. So you should be willing to pay more for quality businesses. Just because a business has a high free cash flow multiple doesn't mean that it's not a bargain, doesn't mean that it's expensive. All of it is relative to the quality of the business, right? If a business is extremely high quality and it's going to grow 10, 15, 20% over 10, 20 years, then paying 30 times free cash flow or 40 times today's free cash flow might still end up being a really good investment for you. That's something that a lot of beginners have trouble wrapping their minds around, and I was one of those. But clearly, I've learned from my lesson, or I'm trying to learn from my lesson. And this tool that I created, Rated A, one of the most important things is the quality rating, right? The quality ratings dictates everything else, the value rating, the income rating. If, the quality rating for a company is F, and the multiple is really, really low, well, guess what? The value rating is still going to be low. It's going to be a sell. Whereas if the company has a very high quality like LVMH, then when it trades for a 22 free cash flow multiple, even though that's more than the average historical average of the S&P 500, then it's going to be a buy today. So this is what, Charlie Munger, Warren Buffett mean when they say pay up for quality. And just a funny anecdote here with Ben Graham. It's famous for being a very deep value investor, very risk averse, always looking for companies trading for less than their book value. The majority of his wealth actually came from, an investment that he made that had nothing to do with his deep value way of investing. It's with Geico. Everyone knows Geico. Everyone knows that's how Warren Buffett made a lot of money. But Ben Graham also made a lot of money like this, and Geico was his most successful investment ever. And it happens to be the one investment where he paid a premium to the book value. And one more thing before we move on. The reality is that a lot of the very rich people in this world, the billionaires, they got there by owning high quality businesses. Let's just take a look at the Forbes billionaire list. Elon Musk. Okay, we can argue whether Tesla is a high quality business or not, but The point is, most of his wealth comes from one business, but he might be the exception here. Jeff Bezos and Amazon, quality business. Mark Zuckerberg and Meta, quality business. Larry Ellison and Oracle, quality business. Bernard Arnault, LVMH, quality business. Warren Buffett, Berkshire Hathaway, quality business. Larry Page and Sergey Brin, Google, quality business. Steve Ballmer, Microsoft, quality business. Amancio Ortega, Zara, arguably quality business. Bill Gates, Microsoft, quality business. Jensen Huang, Nvidia, quality business. Michael Bloomberg, Bloomberg, quality business. Blah, 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 blah. Sam Walton. All of these guys got there by owning one very high quality business. Moving on to the next series of quotes. We bought Seas early in 1972 for $25 million, at which time Seas had about $8 million of net tangible assets. This level of tangible assets was adequate to conduct the business without use of debt, except for short periods seasonally. Seas was earning about $2 million after tax at the time, and such earnings seemed conservatively representative of future earning power in constant 1972 dollars. Thus, our first lesson. Businesses logically are worth far more than net tangible assets when they can be expected to produce earnings on such assets considerably in excess of market rates of return. Leaving the question of price aside, the best business to own is one that, over an extended period, can employ large amounts of incremental capital at very high rates of return. The worst businesses to own is one that must or will do the opposite. That is, consistently employ ever greater amounts of capital at very low rates of return. So we get to the third lesson from Warren Buffett and Charlie Munger here, which is to look for high return on invested capital when looking at companies that we're going to invest in. One thing that sets quality businesses apart from other types of businesses is they can reinvest capital at very high rates of return over extended periods of time, right? In a capitalistic world, when a business is able to get high returns, competition is always going to come in, right? And then the returns are going to trend down to 10%, knowing that 10% is also the cost of capital. But some businesses, some very special businesses, are able to keep this going for 30, 40, 50 years. And at this point of the video, it's a good idea to look at this neat little diagram here, the drivers of shareholder return. When a stock goes up, it can only come from two places. Either it's the fundamental return or the speculative return. The speculative return we have no control over, the business has no control over. That's just the multiple going up or down. In the fundamental return, we have the dividend yield, but more importantly, earnings growth, right? A business that can increase its earnings over time or its free cash flow over time is going to be a business that's going to be worth more in the future. And there's two components of earnings growth, right? It's the amount that the business reinvests in order to grow and the returns you get on that reinvestment. So clearly, Seeds Candy has very high cash on cash returns. If it has a return on invested capital of 20%, every time Seeds invests $1,000, it gets 200 in return the first year, and then it keeps going on year after year. In order to get the best results in investing, you have to find a business that has both of these. So very high return on invested capital and also a good amount of opportunities for reinvestment. What's important to note here is that investors' returns from the stock market will usually match the underlying business's return on invested capital. Given that you're investing for a very long period of time, the speculative return doesn't count for as much. All right, moving on. There are actually businesses that you will find a few times in a lifetime where any manager could raise the return enormously just by raising prices, and yet they haven't done it. So they have a huge untapped pricing power that they're not using. Warren and I raised the prices of See's Candy a little faster than others might have. We bought See's Candies in 1972. See's Candy was then selling 16 million pounds of candy at $1.95 a pound, and it was making 4 million pre-tax. We paid 25 million for it. That's 6.25 times pre-tax, or about 10x after tax. When we looked at that business, basically my partner Charlie and I, we needed to decide if there was some untapped pricing power there. where that $1.95 box of candy could sell for $2 or $2.25. If it could sell for $2.25 or another 30 cents per pound, that was 4.8 million on 16 million pounds, which on $25 million purchase price was fine. The single most important decision in evaluating a business is pricing power. If you've got the power to raise prices without losing business to a competitor, you've got a very good business. And if you have to have a prayer session before raising the price by 10%, then you've got a terrible business. Okay, cool. So the lesson here, based on the last series of quotes, is that you need to be looking for businesses that have pricing power. Businesses that can raise the prices of the products and services that they sell over time without getting any lashback from their customers. But all that is a lot more easier said than done. If you've ever run a business or if you work in a business, you're employed by a business, you know that it's very hard to just raise your prices constantly year after year. At some point, your customers are going to either lash out or they're going to, decide to drop your company for another one that can offer the same things for a cheaper version. What you need in order to be a business that keeps raising prices year after year and still keep your customers is a moat. And not just any moat. There's really two different types of moats, I would say. The first one is switching costs. So if you have a product or a service that's really mission critical and that your client cannot, move away from it because they're tied too deep basically, then at that point you can raise the prices on that service or on that product on a yearly basis. However, if you do it too often or too quickly, your clients will try to still find a solution, an alternative, right? That's what we're seeing, for example, with NVIDIA. All the NVIDIA's biggest clients are trying to build out their own chips nowadays because NVIDIA is just very expensive. Also, if you're the management team that's thinking very long term on a business that has switching costs, why not keep prices low? As you grow, why not keep prices low? At some point, your business is going to get really big. You're going to be able to reinvest all the profits into making things cheaper for your users, and they're going to want to stay with you. They're not going to go looking for other competitors, and it actually is going to be a lot harder for those competitors to even compete with you because you're offering these products or services at prices that they can't offer and still be profitable. The best example of this, Costco, right? So at the end of the day, if you own a business that has a strong moat, but that moat comes from switching costs or from network effects, maybe the best thing to do is to keep prices low for the long term. There is one type of moat where it's pretty much a cheat code and you can raise prices year after year after year, and customers actually like that. And that's brands. Specifically, two types of brands: luxury, right? Ferrari, Hermes. If Ferrari cars or Hermes bags become affordable to the degular person, well, that mode is not going to stay strong. That brand is not going to stay strong very long, right? Those brands are strong because they are exclusive. But think about a brand that's based on gifting patterns. So, See's Candy is one. Think of something like Lindt or Ferrero Rocher, right? Those candies, those other candies that people buy to gift to loved ones. Think about Moet. Think about jewelry like Tiffany's, like Bulgari, right? All LVMH's businesses. For those types of businesses, you can raise prices over time because people like to pay a high price for them, right? The high price justifies the value of the gift, isn't it? So keep that in mind. But definitely, if you find a business that has very strong pricing power, you're on the right path. Let's move on to the next section. Buy commodities, sell brands has long been a formula for business success. It has produced enormous and sustained profits for Coca-Cola since 1886 and Wrigley since 1891. On a smaller scale, we have enjoyed good fortune with this approach at See's Candy since we purchased it 40 years ago. When we bought See's Candy, we didn't know the power of a good brand. Over time, we just discovered that we could raise prices 10% a year and no one cared. Learning that changed Berkshire. It was really important. Guilt, guilt, guilt. Guys won't dare go home without a box of chocolates by the time we get through with them on our radio ads. So Valentine's Day is the biggest day. Can you imagine going home on Valentine's Day? Our See's candy is now $11 a pound thanks to my brilliance. And let's say that there is candy available at $6 a pound. Do you really want to walk in on Valentine's Day and say, "Honey, this year I took the low bid," and hand her a box of candy? It just isn't going to work. So, in a sense, there is untapped pricing power. It is not price dependent. Every person in California has something in mind about C's candy, and overwhelmingly, it was favorable. They had taken a box on Valentine's Day to some girl and she had kissed him. If she slapped him, we would have no business. As long as she kisses him, that is what we want in their minds. C's candy means getting kissed. If we can get that in the minds of people, we can raise prices. If I go to some remote place and I see Wrigley chewing gum alongside Glottis chewing gum, well, I know that Wrigley is a satisfactory product, whereas I don't know anything about Glottis. So if one is 40 cents and the other is 30 cents, am I going to take something I don't know and put in my mouth, which is pretty personal place after all, for a lousy dime? So, in effect, Wrigley, simply by being so well known, has advantages of scale, what you might call an informational advantage. So, that brings us to the fifth lesson: brands can create moats. I'm not going to dwell too long on this point since we were just talking about that in the point number 4. However, I do want to bring up one very important issue. And this kind of brings back the first lesson, which is always be learning, always be educating yourself. Like I said in point number 1, times change, and the way you invest throughout times should be different, right? Since the rise of the internet and social media, now it's just possible to advertise to anybody with a small budget, right? And very targeted to the audience that you want to reach. And that has made it such that very small brands with a lot less scale can still be very visible. So that's something to keep in mind. Nowadays, just having a brand and just having a well-known brand is not enough. Warren suggests getting your brand into the gift market because people don't give second-class gifts. If you price your new whiskey brand at 5% less than the leading brand, you'll have a hard time gaining customers. The higher priced one is both better known and more expensive, reasons the customer. Why get something inferior just to save a few dollars? This is especially true when the product will be a gift. No one wants to be seen as second class. The new whiskey would actually market itself more successfully in Grey Goose style, as a premium brand with a matching package that helps the potential buyer overcome much of his hesitancy. Even though I've never had it before, it looks elegant and costs just a bit more than the brand I was planning to buy. It makes an impressive looking gift that my host would enjoy. I'll give it a try, the thinking goes. That See's Candy sells boxed candy, mostly bought as gifts, is a fundamental way that its business differs from other businesses that sell something that people eat. So, lesson number 6 is pretty much in line with lessons 5 and 4, and it's that not all brands are created equal. Like I just said before, if you have a well known brand like Clorox, that reduces the cost of search, right? Same way Warren Buffett mentioned the gum example. That means if you're in a hurry, if you look at the shelves, if you're in a foreign country and you see Clorox, you know that that's a high quality product and you're probably going to pick it even though it's a bit more expensive. That's not a super strong mode nowadays with all the digital marketing and the way, the advertising industry is evolving. It's much better to have a brand that's in the gifting business or the luxury business. So if you remember, I was mentioning LVMH at the start of this video. That's a company that I've been buying. Look at LVMH. The brands include all these fashion and leather goods, brands like Moats, Veuve Clicquot, Hennessy, Dom Perignon. Obviously, as you'll know, alcohol's a very big gift that people like to give. And the pricier the bottle, the better the gift, usually. We got perfumes, we got jewelry, Tiffany & Co., Bulgari, watches. Jewelry and watches, once again, gifts that people like to splurge on because it shows that you care for the other person. Okay, we're done with all the lessons related to branding. Let's move on. The ideal business is one that takes no capital and yet grows. And there are a few businesses like that, and we own some. Two factors help to minimize the funds required for operations. First, the product was sold for cash, and that eliminated accounts receivable. Second, the production and distribution cycle was short, which minimized inventories. Last year, Sea's sales were $383 million and pre-tax profits were $82 million. The capital now required to run the business is $40 million. This means we have had to reinvest only $32 million since 1972 to handle the modest physical growth and somewhat immodest financial growth of the business. In the meantime, pre-tax earnings have totaled $1.35 billion. All of that, except for the $32 million, was sent out to Berkshire. We've tried 50 different ways to put money into C's. If we knew a way to put additional money into C's and produce returns a quarter of what we're getting out of the existing business, we would do it in a second. We love it. We play around with different ideas, but we don't know how to do it. By the way, we really shouldn't complain about this because we've carefully selected a bunch of businesses that just drown in money every year. So, what's the lesson here? The lesson is it's okay to have a slow growing business. Some businesses just don't have the means to reinvest at high rates of return, even though the underlying business is great, and that's okay. The problem lies in the corporate world and in management. You know the saying that goes, work expands to fill up all available time? Well, in the corporate world, projects and acquisitions expand to soak up all the available cash. It's just how it is. Management loves to be busy. Management will always find a team of dedicated people that will always find good reasons and justifications why they should acquire a new business and say that, the acquisition will provide great returns on investment. Yet we know that 80% of acquisitions end up being bad and unprofitable. And I guess the real lesson here, and I made a slight tweak to the original lesson, is it's okay to have a slow growing business that is highly profitable. If your business is slow growing and unprofitable, get rid of it. And I just want to make a little parallel here because Rated A invests in tobacco companies. Actually, British American Tobacco is the second largest holding in this portfolio, and Philip Morris is also there. These companies have something in common. They generate huge amount of cash flows that they redistribute to shareholders via very big dividends. And because, as we all know, the cigarette industry is in decline, volumes are going down year after year, they don't have a lot of places to reinvest. Maybe Philip Morris, we can say that they're reinvesting in, cigarette alternatives, tobacco alternatives, and they're doing a really good job. But other companies like British American Tobacco or Altria, for example, they're not reinvesting all that much. And I don't know if you remember, but Altria made some huge, very horrible acquisitions in 2018. They had Kronos, they had Juul. They spent billions and billions that were wasted on those companies that ended up being worth zero. And actually, Altria shareholders would have been much better off if Altria management had just decided to take that money and give a huge special dividend to shareholders, right? My point being is that if you own a company like that, it can still be a great investment so long as management doesn't mess everything up and try to make acquisitions to turn around the business. If they're just able to take their profits, give it back to you, and you are able to reinvest into new investments, then it can still be a very good investment. After paying corporate taxes on the profits, we have used the rest to buy other attractive businesses. Just as Adam and Eve kickstarted an activity that led to 6 billion humans, Seas has given birth to multiple new streams of cash for us. The biblical command to be truthful and multiply is one we take seriously at Berkshire. It takes almost no capital to open a new See's candy store. We're drowning in capital of our own that has almost no cost. It would be crazy to franchise stores like some capital-starved pancake house. We like owning our own stores as a matter of quality control. Because we still have this ability to redistribute money in a tax-efficient way within the company, we can reallocate it to where it will earn a higher return than shareholders may on their own. There are two kinds of businesses. The first earns 12% and you can take it out at the end of the year. The second earns 12%, but all the excess cash must be reinvested. There's never any cash. It reminds me of the guy who looks at all his equipment and says, "There's all of my profit." We hate that kind of business. The lesson here is that cash is king, or free cash flow is king. As investors, when you look at a company's financial statements, free cash flow is the money that's there to be used by management to redistribute via buybacks or, make acquisitions, pay down debt, or pay dividends. Seas Candy generates tons of cash, and that cash is not used to open new stores or growing the business. It's sent to Buffett, and then Buffett can reallocate it. And the simple reason is that the management at Seas Candy just cannot use all that cash and reinvest it at high rates of return. So, what you and me are looking for is businesses that can redistribute capital to owners and shareholders without inhibiting their ability to grow. That's why I like to focus on dividend paying companies on rated A. To me, the perfect investment is one in a company where that company is able to still give you part of their profits and still grow on the side at the same time. Just because a company pays a dividend doesn't mean that it's not growing and reinvesting. As a matter of fact, if a company is very profitable and very well established and has a strong moat, they're not always going to have the most reinvestment opportunities. That being said, when you have a business that's of very high quality, like Seas Candy or like Berkshire, I have the Berkshire stock chart here because obviously Seas Candy is not available. You give yourself a lot of leeway, a margin of safety just by buying into the high quality business. An investment into a business like Berkshire Hathaway is very forgiving. What that means is that even if you buy at the wrong price, like when it's expensive here in 2007 or in 2015 or in 2020 or in 2022, you're still going to do well, right? It's hard to lose money over long periods of time when you have a high quality business, even if you overpay a little bit. Once again, LVMH, another thing that's worth noting here is, do you notice the similarities between Buffett and Arnault? Luxury is an industry where reinvestment rates are not very high. What happens if you're a company like Hermes and you have a lot of cash on hand? Are you going to open stores at every street corner available? No, you have to remain exclusive, right? Otherwise, you dilute the brand. That's what happens. That's the main risk for luxury companies. So when LVMH acquires a luxury company like Loro Piana, for example, Loro Piana, I'm sure, is very profitable. And I'm sure they have a lot of excess profits that they send back to LVMH headquarters, to Arnault, so that Arnault can keep using that cash to make new acquisitions or to fund marketing for smaller and less established luxury brands. That's exactly what LVMH does. That's exactly why LVMH is a very strong company. Because if you're a standalone luxury brand, you're not going to be able to grow as fast as LVMH. Because, same as Seas Candies, the reinvestment rate, the reinvestment opportunities are just not there. All right, moving on to the last lesson of the day. Munger. Some great businesses have very volatile returns. For example, Seas usually loses money in 2 quarters of each year, and some terrible businesses can have steady results. Buffett. Our company's song is "What a Friend We Have in Jesus." I bought it in 1972, and every year I have raised prices on December 26th, the day after Christmas, because we sell a lot on Christmas. In fact, we will make $60 million this year. We will make $2 per pound on 30 million pounds. Same business, same formulas, same everything. 16 million bucks, and it still doesn't take any capital. And we make more money 10 years from now. But of that 60 million, we make 55 million on the 3 weeks before Christmas. This brings us to the ninth and final lesson of this video, which is don't run away from volatility. As an investor, volatility can be your friend. And when I say volatility, I don't mean volatility in the stock price going up or down. That's beta. And if you're a serious long-term investor, I don't think you should be considering beta as risk. But the point is, a lot of actors in the stock market do consider beta as risk. But as long-term investors, a business that is volatile can actually present great opportunities because a high quality business that has very consistent results is never going to go on sale. Check the stock charts for Constellation Software, check the stock chart for Costco. There's rarely any dips, and that's because those results are very consistent, very safe. Now, there are other high quality businesses that have inconsistent periods of earning free cash flow. And what's nice about that is that when the cash flow dips for a little while, investors usually run out the door because they get scared, they get frightened. So, if you're going to be a long term successful investor, it helps to identify high quality companies beforehand and know when there's a dip and understand that the dip in cash flows is due to cyclicality, volatility. So let me bring up LVMH one last time. And this company has been going through a dip lately. Part of that is due to the consumer in China not having as much of purchasing power, economic recession looming, in the distance, people not spending as much on LV bags or Dior, all that. The question is this temporary? Or is this a secular trend that people are going to stop spending on luxury items? My view is that people will always be willing to pay very exorbitant prices in order to feel special. So, long story short, I think this is temporary. I think this is just volatility in the company's sales. And I think when a high quality company like LVMH is trading at a free cash flow multiple of 22, that's a buying opportunity. So that's where I'm allocating Rated A's capital. This is not a recommendation. You can do your own research and do what you want. I'm just trying to illustrate how I take Warren Buffett's and Charlie Munger's lessons and how I apply them in my own personal investment journey. That's the end of this video. I'll leave the link to the Rated A platform in the description below. Check it out if you want. It's free for an entire week. You can cancel at any time. There's zero risk. I hope you learned something from this video, and I'll see you in the next one.